Welcome to What Matters, the podcast where we unpack the key trends shaping markets, investing and the economy. I'm Tom Brown, and this is our first episode of the year. The specific topic, our 2025 investment outlook. Over 2 episodes, we'll speak to experts behind our latest outlook report, giving them the chance to expand on their insights and forecast the big trends for the year ahead. Joining me throughout is Andrew Pridham, Vice Chair of MA Financial, co-host and founder of this podcast, who will share his perspectives on what's shaping markets in 2025. Andrew, welcome, as always, for the start of the year, our podcast year.
Hello, Tom. It was great having a break from you, but we're back. Excited about it.
Little jab early on, I like that. Today, we're starting with private credit, one of the fastest growing asset classes. We'll hear from Frank Danieli, Managing Director and Head of Credit, Investments and Lending here at MA Financial, on where opportunities lie, and from Drew Bowie, Managing Director and Head of our Real Estate Credit Practice, our real estate lending practice on real estate credit. Drew and Frank, a very warm welcome to What Matters.
Morning, Tom.
Good to be here, Tom.
Frank, fresh back from New York.
Fresh back from New York and here to talk about credit. And can you believe that private credit is one of the sexiest and hottest asset classes around?
You kept telling me it is, Frank, so I'm looking forward to hearing from you in this episode. I guess first off, it's worthwhile for our listeners, Drew and Frank, if you just explain a bit about what you do, what your specific focus is, the number of funds you both manage, and I guess roughly the funds under management.
Well, Tom, in 2017, we launched a series of first mortgage real estate credit funds to provide access for our investors into bank-like product into real estate lending. So we've invested in excess of $4 billion over that time, and it's been a tremendously successful strategy.
Yeah, well, look, I oversee a range of diversified private credit funds that's involved in direct lending, asset-backed lending, and specialty credit. And Tom, as you say, that spans both Australia and the United States. Now, those terms are pretty technical, but in plain English, what we really do is try to run a series of investment funds to make loans out there in the real-world economy. And the loans that we do are really things that banks used to do, but they can't really do them well anymore. That might be because of regulation or the way market structure or technology has changed things. And so that gives us the opportunity to go in there, step in and provide a credit solution to a borrower who needs capital.
Frank, in the report, you talk about the growth of private credit. You mentioned how it's sort of become one of the sexier asset classes, which has happened, some people think, over a short period of time, but it's been obviously evolving. Talk to us about the growth of private credit and the outperformance, as you've identified, compared to, for example, fixed income.
Well, private credit's really changed, Tom. So when I started in my career, I was in sort of the dark side of credit, in investment banking, doing the workouts of debt gone wrong. And at that time, private credit really meant things that were distressed, that banks had on their balance sheet they had to get rid of. And that's not where the growth has been. The reason this industry has grown is that what has happened is that it's become harder for banks to do certain types of lending efficiently. But out there in the real world, whether they're companies, businesses, assets, or people, they need capital, they need loans. And an industry has developed to be able to step in and provide those solutions out there to borrowers. So we've seen now more than half of the entire private credit industry become performing lending, which is really this concept. And that's been supported from investor demand, because what investors are seeing is that they can actually step in and participate in this disintermediation of the banking market and the finance market and earn quite a compelling return. The returns that have been delivered are generally quite a premium to what you can get in traditional fixed income like bonds, but you get that with lower volatility.
So if you're interested in investing in private credit or adjusting or increasing your allocation, what factors, Frank, and I'll open this up for discussion obviously also, do you see as being particularly important in 2025?
Well, if you're going to think about participating in private credit, what really matters is what's under the hood. Private credit's a very broad term because it just means lending that isn't in the banking system or isn't a bond. So it could be a whole bunch of things. Now, what really matters when you're thinking about participating in this space is, where are the loans that the private credit manager is making coming from? Have they been originated on a proprietary basis? We really think a lot about that. We have an entire lending ecosystem we've built to curate and to originate loans for the benefit of our platform.
So by that, just interrupting, you mean proprietary process. We write the terms of the loans that you're making. They're not standardized documents. You're inputting clauses into those to protect us.
Well, that's certainly our view. It's not everyone's view in the industry. In fact, the industry is probably split. A lot of private credit is really just people running a fund and then going around and buying pieces of other people's loans. Now, that's not our brand of private credit. Our brand of private credit is about going out and making loans ourselves, structuring debt terms, facilities, pricing and covenants, and making sure that we're in control. The second thing that I think is really important for private credit is alignment. That is the concept that you eat your own cooking and that the manager themselves are participating in the funds. You know, here at MA, we've invested over $190 million between firm and staff in our private credit strategies alongside our clients. And so we really care about the underlying funds because we're an investor too. And then the final thing is, I call it workouts. And that doesn't mean that, you know, your private credit managers out there working out. I mean, I'm sure this is being filmed. You can see. Well, we can probably Photoshop that. We'll actually make it look a bit better. But what workouts is really important in credit, and that's basically the idea that credit is about avoiding losers and not picking winners. And that means that when things do go wrong, you need to go in and protect your capital, but you also have to avoid the problems in the first place. And so having workouts capabilities, I think, is going to be a big differentiator of performance for any manager of private credit through the next cycle that we go through.
Andrew, it's worth touching on that. I mean, you were instrumental in setting that workouts capability up within the firm when you founded the firm with Chris Wyke. I mean, we talk about workouts, but it's a key differentiator of where we see, I guess, our expertise and the expertise of MA Financial.
I think so, Tom. I mean, if you go back to the very most basic principle of why do people want to invest in private credit, you know, why is it growing so quickly? Nothing grows, no asset class grows quickly unless there's a demand. And what investors are really after is yield. There's a lot of we're now in a point in the cycle when the RBA is starting to reduce interest rates, and that's great if you're a homeowner and you're paying your mortgage. But there are a lot of people in this world who are actually net investors, net savers, and they actually benefit from higher interest rates. And what private credit really is providing them, as opposed to many other asset classes, is a reliable income stream to pay for whatever they want to do in their life, whether it's in retirement or they're building their savings. So private credit is giving superior returns to, say, bank interest or public debt markets, fixed income type markets, and certainly many equity funds. And I think one of the misnomers that's existed as long as I've been working in the financial services industry is many investors are very familiar with real estate and they're very familiar with shares. And they tend to look at anything that's credit-based as risky because it involves debt. And this thing, well, if you have debt, it's risky. But what they fail to recognise is that in a private credit fund, you own the debt. You are lending to somebody else who has to repay you back under a contractual arrangement. So it is a fantastic, if it's well managed by responsible managers, investors get a great outcome because they're getting superior income, regular income returns. And even if a loan goes bad, as Frank has touched on, in equity, if a company goes bad, you typically lose most or all of your capital. But very often, and more often than not, in fact, usually, Frank, I think it'd be fair to say, certainly in our long experience, if a loan goes bad, and sometimes they do when you're doing lots of different loan situations, that does not equate to you losing capital, because often and usually you can work your way through it and get repaid your full principal and interest. So I think that's what's driving the sector, and I think it's going to continue to grow and deliver great risk-adjusted returns.
And yet many of those investors have held mortgages themselves or taken out mortgages from the banks themselves. And I'm sure when they think back on those mortgages that they've had against their houses, etc., they probably think that the bank was in a pretty good position.
Yeah. Well, you are. I mean, if you're a lender, you're in a much stronger position than the equity holders, that's for sure. And that's really the thematic that private capital funds, private debt funds are delivering for investors, is putting yourself ahead of the equity, but getting close to equity type returns.
Well, I think you also want a manager that has seen debt itself go wrong, because that enables them to work out how you avoid a problem in the first place and how you set things up so that if something does go wrong or the world changes out there, you go through a cycle, some sort of low probability event happens, you actually know and you've set yourself up well to go in and to make sure that you can get your money back. I mean, lending is all about putting a dollar out the door and making sure there's a really high chance you're going to get that dollar back and that you get your contractual interest along the way.
Frank, in the report, Outlook report, you said this year we continue to have strong conviction in asset-backed lending being essential and an innovative element in Australia's private lending landscape. For the initiated, they'll know what asset-backed lending is, but could you just take us through that? It's an interesting thematic that's is part of your strategy this year.
Yeah, asset-backed lending means financing a whole portfolio of loans. So rather than just one loan that you make, you set up a way to finance an entire portfolio, meaning hundreds or even thousands of those loans. And you do it in what I call real-world economy areas. So this could be things like certain types of home loans, car loans, business loans, equipment loans, asset finance, supply chain finance, receivables. So things that are just out there in the real world. And what you're really doing in this thematic is stepping into that area where banks can no longer provide those particular types of loans, or where they have to actually partner with a credit fund or a specialist lender to provide that solution. And that's what you're doing. So it's a really interesting area, a way to get access to high grade credit in areas that have actually been around for a really long time. If you think about all those things I just said, I mean, types of home loans or car loans or business loans, these things have been around for more than decades, centuries.
I think that's the interesting thing when people try and bifurcate private credit managers from banks. The reality is that the loans that private credit companies such as us are providing are loans that the banks used to provide. And if you think about all of the banks used to own finance companies and do car loans and do all sorts of things, construction loans, they're just not in that business anymore in reality. Often we do partner with the banks, and it's certainly a big thematic with our business in the United States, for example, where the banks may be originating loans and we are participating with them alongside
And Andrew,
them.
I think that's something that's really misunderstood, which is often you see private credit positioned as this thing that's fighting against the banking system or fighting against what people say as or traditional finance. But actually what's really happening is that we're partnering together to provide these loans out there into the real world. And it's just a slightly different way of achieving the same outcome of providing loans to borrowers.
Some people might say, well, if the banks have pulled back in those lending spaces, it's inherently because of it's more risky, but there's a whole range of factors, prudential standards and so forth, why they've pulled back. And that's why private lenders such as us have stepped in.
That's true. And those areas, Tom, can get very technical when you start thinking about banking regulations and so on. But that is that's right, prudential standards. I don't want to start a lesson on that here, but yes, those things do happen. But the other thing that's happened in Australia especially, and we see this through our Finsure business, is that the way that you get a loan today is really different than the past. In the past, if you want a loan, what do? You walk into a bank branch. Now, 75% of loans in Australia, doesn't matter if they're home loans, car loans, business loans, whatever, they go through a broker or an intermediary. And that's one of the reasons why we've seen such growth in the Finsure platform. But we see a lot of data in this through that ecosystem. There's $130 billion of loans on the Finsure platform. And so now that loans go through a broker, what happens is a borrower goes and sees their broker or their advisor, and that broker goes and looks out into the whole market and says, right, who can provide this solution for my borrower in the most efficient way for what they want? And that doesn't just mean that it's cheaper. It might mean that they understand the nature of their business, them as a borrower or whatever. But that's really changed the market. So things like the rise of the broker, technology, other market structural forces have really changed the game, and that's supporting the development of this industry.
I think, and if we look at our real estate credit business, which Drew can speak to, one of the factors that's very, very significant is service levels. And banks are enormous organisations today in a very complex world and financial world. their core businesses really are lending against residential real estate, commercial real estate, credit cards, those sorts of things.
Scalable things.
Scalable things, things that's lower touch, that they can use their cost of capital advantages to lend at a lower cost of capital. But service is incredibly important, particularly in something such as construction, residential construction, where it's hard enough to build a block of apartments, Drew, as it is, without worrying about money. And one thing developers that are clients of ours tell me, repeat borrowers from your fund, is what amazing service we give. And maybe you just sort of explain what that means.
Yeah, well, it's critically important. There are so many headwinds for developers to get into the market that once they're in there, they need quick responses. They need people who understand the pressures that they are under, can respond to those pressures and find solutions in a timely manner. And that's worth a lot of money to them. It's a bit of a misnomer when we hear that the banks have pulled back out of the market. In fact, they continue to support the market as much as they can. In fact, they've got the same amount of dollar exposure in this market, in the real estate credit market, as pre-GFC. So they want to be in the market, but the sheer volume of, particularly in residential construction, where there's such a shortage of housing, but developers need really quick responses to access those markets. And again, having people who can respond quickly. During COVID, we were able to respond really quickly to ensure developers that we were going to be able to support them through those challenging times where the whole world didn't really know how to address the situation.
Drew, the value of that hands-on expertise that your team has, that's actually quite unique out there. You've got MA hard hats and fluorescent vests, and I know sometimes you say that you have people in the team that wear steel cap boots and not just loafers. That is actually, it's important, but it's also unique.
Fundamentally, we love it, Frank. We love being out on site. We love real estate. I love the bricks and mortar nature of it. I love driving past sites that I was involved in, decades ago. That's the fun part of the job. We think about enduring value before we go on risk on any one project. We think, does this asset have enduring value? Is it a good design? Is it fit for purpose? Is it fit for the market that it's meant to be attracting? And if you get that right, we can't predict when markets will drop. Thankfully, in Australia, residential markets don't drop far and they don't stay down for long. But we can't predict when the next one will happen. And so if you are investing in those assets that have enduring value, those markets, those assets will be, firstly, there will be opportunistic buyers if the market does drop. And even if that is not the case, then they will be the first assets to recover when the markets recover. And if you're not investing in an enduring valued asset, if it's a poor quality asset right from the start, it's just going to be an older asset, poor quality asset when the markets recover. So if you focus on that, you've got downside protection.
In terms of our business model at MA Financial, in terms of being a private credit lender, particularly in real estate, which is something I'm very, very familiar with, it's really important, this service aspect, that we can be nimble, and that means we can give developers and borrowers, whoever they may be, reasonably quick responses to their issues. Because anyone that's built in the last 100 years, as I often say, there's two things for certain. It takes longer and it costs more. So you need a nimble lender to be a partner with you as you're going through that process, to be able to adjust as things go wrong. As you might have ordered a window package for a large construction and it gets delayed, or the window manufacturer goes broke, for God's sake. These things that come up, you need to be nimble, but you also need to have a high degree of sophistication. And this is something that is a theme that runs through our entire business, is making sure we have depth of experience in the real world and significant backing and capacity in terms of capital and people, that we actually understand what's happening. If things go wrong, we can adjust. We have the capital to endure. If a development, for example, if the pre-sales take longer than you expected for some reason, if there's a blip in the economy, or the project takes longer, or a supplier to the project goes broke, you need to have endurance, and you need to be able to hang in there, don't you, Drew? And that's something I think we've been really, really good at.
And a couple of popular discussion points in real estate credit, which you raise in the outlook very succinctly, Drew. You're positive about senior secured debt and fundamentally good assets, which you touched on. But we're seeing competition at the moment amongst some lenders, and you think there could be some mispricing of risk. What are you seeing there, and how are you dealing with that?
Well, the market has grown quickly. And when I think about private credit markets, it describes a huge diversity of managers. It describes a huge diversity of investable products within private credit markets. Just real estate is just one, but within real estate credit, there's senior debt, there's mezzanine debt, there's pref equity, there's joint venture equity. Some managers have pushed into equity positions, but they're still called a credit manager, which is not inappropriate. They're servicing a client need. But within that, there's various levels of risk, and within that, there's various levels of cash positions and targets that many managers are trying to meet, sitting on large cash. So that puts a bit of pressure on some managers, I think, to write the wrong deals as opposed to say to their investors, we're sitting on a lot of cash. This is what we're earning on your cash. It's your decision what you do with your money, but keep them very informed around that so they have that power of decision. What we do not want to do, and what we are seeing is some loans being written at considerably cheaper rates than they were in other markets, yet the market hasn't changed dramatically. In fact, if anything, some of the market's weaker, and yet the pricing of credit has tightened significantly.
That's interesting. And you also write in the report, Drew, there'll be little distinction, you touched upon this slightly, but there'll be little distinction between the traditional real estate credit managers who have pushed into equity positions. So understanding where their portfolio challenges lie will be important for investors.
Yeah, well, again, that goes to what are they investing in, and is this a first mortgage? Is it a second mortgage? Is it some of it offshore, some of it in New Zealand or parts of Asia? Our focus is only first mortgage credit in Australia, in those asset classes that are relatively liquid. Real estate's an illiquid asset class by definition. So we're looking at the traditional asset class of residential, industrial, those sorts of assets, and not moving into those sectors that can be more challenging to understand underlying value or liquidity.
So you see heightened risk in mezz debt, it says here, and preferred equity?
I see heightened risk. It's all about control. I think if you don't control the position, then you're beholden to the decision of others, and you take that. You're backing a manager, but if that manager doesn't have control, who does? One thing that came out of the GFC, and that is a substantial tightening in subordination agreements between senior and mezzanine or subordinated lenders, and so it's a really backseat position. As a mezzanine lender, you may not be aware of a problem, how the problem is going to be fixed, when it's going to be fixed. And so you really are beholden to other people.
I think it's pretty important that whatever lending enterprise we're involved in, we actually want the borrower to complete the project or to sort out their problems. You don't deliberately lend to want to own the equity because it moves into a different investment risk. But a broad question for both Frank and Drew: if someone's looking at investing in private credit, can you just explain what sort of returns, into just simple terms, what sort of returns can they expect, and what are the liquidity options available in terms of investing?
Private credit's a floating rate asset, so generally an investor can expect anywhere from about the cash rate plus 4% up to in the order of 5 to 6% above the cash rate. It really does depend on the nature of the fund.
For those that don't know what the cash
rate is?
So
that's between 8 and 10% is how I think an investor should think about that today on a net basis, and they're going to get that income.
Typically, is it paid quarterly, monthly?
Monthly.
Similar in first mortgage real estate credit, in our funds, we have an open-ended fund that provides income distributions monthly, also the ability to redeem monthly, and to apply monthly. So, it's their money. We're giving them a choice to invest how they see fit, and their own their own circumstances will change over time. So we're enabling that. But 6 to 8% for a first mortgage position is pretty much the market norm.
Yep.
And Frank, it's an historic time for MA because you've just launched the MA1 fund, which is giving, and as part of the outlook, you're giving investors more ways to invest in private credit, in particular through a listed structure. And you see that as being a potential trend this year.
Yeah, MA1 is the first time that what we call our flagship private credit strategies, so it's our real estate private credit strategies, our asset-backed and our corporate lending strategies, both in Australia and the US, will be available for investors via the ASX. So nothing in there is new. It's not a new fund. These funds have been around for a long time and they've been operating, but this is just a new way for investors to access that and access it on the ASX, which basically means you can have daily liquidity. And to date, we've managed to, what's $5.5 billion of private credit funds that are in private form. And so it might be monthly liquidity perhaps, but on the ASX, you can have daily liquidity. And I think that's something that's going to grow substantially over time.
And your yield or your interest on that, I presume, is calculated daily, so that the number of days you're in the fund. So you could be in and out and accrue interest as opposed to having to be in for, say, 30 days plus end of month.
Yeah, that's right. Look, you'll still receive monthly income, which will be in the form of a monthly dividend if you're invested in the fund, but you can trade in and out every day.
And Drew, just pivoting back to real estate credit while I could, you talk about the demand drivers for real estate credit. How do you see the demand landscape for loans this year, i.e. developers, and I guess from a supply side?
Well, when we think about the real estate credit market, it is weighted towards residential sector. There's been an all-time low in new construction starts. We've all read and heard about the residential housing supply crisis. I think it's real. Just looking at the sheer numbers and lack of commencements versus population growth. What we have seen over recent times, firstly, all the governments appear to be aligned in the fact of accepting there is a housing supply crisis. How they'll go about fixing it may change from government to government. But we have seen recently, particularly at the state level, and I'll call out New South Wales here, where they've announced new delivery authorities, etc., to try and speed up the access for approvals for developers. So, and now that we have construction costs normalising in terms of the rate of increase is now back to sort of more normalised levels, the financing cost has dropped a little bit. We should see a lot more construction starts over the next year or so.
I think state governments can play a big role in the housing supply question. The challenge is going to be, firstly, it is a very complex issue, and that's why we're not getting easy answers. And I think sometimes one of the problems with politicians is they want easy solutions that you can do a press conference and put out a press release and say, well, we've now got this policy number 3027, so that's the answer. It's not that simple. We're going to see, I think it's really interesting, Drew, with some of the planning decisions that the New South Wales state government has come out with, and I know Victoria is following suit, how that's going to play out with the local councils, who are the principal approval authorities. That's not going to be a happy relationship, I suspect, anywhere, because most councils in Australia have a pretty simple philosophy, which is to stop any construction or any change in their local area, and the state government's trying to push it. So that's going to be a thing I suspect will keep the courts quite busy in the coming years, Drew.
Well, there's, absolutely. If you look at development approvals, back many years ago, you would have an approval with maybe 10 conditions. Now there would be 80 conditions on that development approval, and any one condition can stop a deal from being viable. And the amount of consultants reports required for any DA, normal size project, you're probably talking about 20 consultants, 30 consultants to be able to get those applications approved. So it's a lot more complex than what it was. There's also the question of infrastructure. So we're announcing, big open new development areas, but they require a lot of infrastructure. And I think there's a lot of efficiency. There's a lot of low-hanging fruit amongst governments around efficiency of their own corporations that would streamline approvals and speed up the delivery.
Yeah, I mean, one of the big things that's in any endeavour is very challenging is culture, and I think that the real challenge that we all have is that we need to see a change in culture in a lot of the approval authorities, the unions. I'm talking like the Sydney Waters, the Ausgrids, those sorts of organisations. We need a cultural shift, which is a can-do. Let's get things happening. Let's get things moving, rather than let's see how long we can make it take. Because we can keep more people employed, because the employment will actually come by getting more activity going, and that'll be better for everyone. I think that's going to be the biggest challenge, Drew.
Yeah, on a typical 18-month construction program, most lenders are factoring in an additional 6 to 8 months based on inefficiency within governments. Now, that really throws out the viability of a lot of projects, and increases the loan to value ratios, increase costs further. So it is a real challenge, but it's an addressable challenge.
Drew, I'll just wrap up by perhaps asking you, what's your general message to investors thinking of investing in real estate credit this year? Is it about manager experience and platform strength, which you touched on in the outlook?
Always has, always will be, Tom. There's a lot of managers out there. It's a good product, and that's why there are a lot of managers out there trying to capitalise on this renewed interest in a sector that's been around for a long, long time. So yes, transparency, governance, they will be the critical things. Long-term thinking. You don't want to be chasing a market down just for a short-term gain. You really need to be disciplined in the approach, know that this is a defensive asset class, and be investing appropriately. But transparency, governance, and a manager who's aligned and long-term thinking, that's a really good start.
Probably an old computer acronym I remember was WYSIWYG. Do you remember WYSIWYG?
Just.
What you see is what you get. I think that's probably what you're saying, Drew.
Totally.
I like that. And Frank, you've got an historic week, I mentioned, because you've got the ringing of the bell at the ASX this week for your MA1 fund. It's tremendously exciting.
It is. Look out for it, MA1 on the ASX.
Thanks, Frank. Thanks all.